Good afternoon, everybody. Welcome to part 2 of the home buying presentation webinar series of the spring presented by Affinity Federal Credit Union. Today's topic is the steps. My name is Oscar Cordova, and I'm the External Affairs Specialist here, External Affairs and Financial Education Manager here at Affinity, in charge of the financial education efforts of the credit union, focused in the areas that we serve. Before we begin, I would like to go over this brief disclaimer. The disclaimer states that the information provided to all of you this afternoon is intended to be for informational purposes only. It is not intended to be actual legal, tax, or financial advice. Since this is a home buying webinar, if you want to have a conversation with a mortgage loan officer, I will be providing information on how to contact one. That way you can get all of your questions answered by a professional. Now, just because I said this doesn't mean that you have to hold your questions until you talk to a mortgage loan officer. I highly encourage everybody to ask questions during the presentation. That way they can be answered in this session. Today's presenter, her name is Caroline Morgenbesser. Caroline is our AVP of Mortgage Originations. She leads a team of 18 mortgage loan officers who work diligently to provide the best experience for our members. Caroline has been in the mortgage industry for over 35 years, and she loves assisting members with achieving their dream of home ownership. As a reminder, this webinar is being recorded. So the link to be able to rewatch this presentation will be shared with all of you in a follow-up email that will be sent to you tomorrow. During the day. Also, if you have any questions, as I mentioned before, please use the Q&A, and Caroline will be more than happy to address them at the end of the webinar. As a final note, I will be sharing important links throughout the webinar in the chat for all of you to access important information about the home buying process, as well as other valuable resources Affinity has made available with your membership. With that said, I'll turn it over to Caroline. Caroline, thank you so much for joining us this evening to present this great topic to our audience.
Thanks, Oscar. Welcome, everyone. Don't forget, use the Q&A for your questions. We'll answer every question at the end of the presentation. The chat box is going to be where Oscar is putting up the links for you for your convenience. You can see the next two webinars that are coming up on May 31st, and then the last is credit on June 7th. So in the last webinar, we covered the costs, which are daunting to say the least, and it was a little eye-opening. In this webinar, we're going to talk about where to start after you have the desired amount of funds in your account and what happens next. Keep in mind, we're here to help you, and any step along the way, please use my email, carolynm@affinityfcu.com, so that I did get some questions last week when I signed on in the morning. I love it. Keep them coming. I'm happy to answer them. Okay, so what do you do, right? You have the money, you're ready to start looking. Do you go get a realtor or do you get pre-approved? I'm going to tell you, in this market, you get pre-approved. Most realtors will not even show you a home unless they know that you're pre-approved. What's the difference between pre-approval and pre-qualification? Pre-qualification, it's a tool, it's a useful tool. It tells you maybe at the very beginning when you start saving for your home or before you even start looking for a home, how much home you could potentially qualify for based on current rates, what you have, down payment and closing costs, etc. Pre-approval goes one step further. Pre-approval is we collect your income and asset documentation, we pull your credit, we submit that to an underwriter, who then underwrites your loan, your pre-approval application, based on all the documentation you've provided, and will issue a conditional pre-approval based on the documents you submitted. This is vital, right? Because it's vital for a couple of reasons. First of all, when you're pre-approved, you can go out looking and say, and know that you qualify for the home. We'll have an estimated payment for you. We'll have estimated taxes based upon the area in which you're looking for a home. But also, when you find a home and you go into contract, most of the work is done for you already because you've been pre-approved. It helps make the process, I don't ever want to say stress-free because obviously it's a big financial transaction, but it makes it less stressful than normal, than without having the pre-approval. Why? Because we've already looked at your income, assets, and credits. There are no surprises. Okay, hang on one second. Sorry, if you were with me last week, I thought I have a cold. I think it's allergies, so I do apologize. Knowing how much you qualify for, it's great. In New Jersey, you know, we're using 460. We use 460. That's based on numbers as of June 30th, 2022. Last webinar, we used a purchase price of 360 and a loan amount of 349 and change. Okay. There's a simple formula you can use to see if your income is sufficient to support a mortgage. Now, this is not the be all end all, okay, but this is the desired ratio of income that you would need to cover principal and interest, private mortgage insurance if applicable, real estate taxes, and homeowners insurance. Any other debt, you have monthly minimum payments on your credit cards, car loans, leases, student loans, etc. 43% of your gross monthly income, that's the desired amount. If you're at a 44 or 45, I've seen people at a 49 get approved because they had a very strong deal, 20 years on the job, very low consumer debt, right? Not a lot of consumer debt. So 43 is the guideline. Okay, that's the guideline, but you can go over. Now, if you're pre-approved, we're going to know exactly what you qualify for. Let's say you submit a pre-approval application, your loan officer is going to go over it with you, and they're going to say, listen, your ratio is too high. We've got to get it down. So how do we get it down? A couple ways. We lower the purchase price and loan amount. That's always the first one we go to, right? Or we say, okay, you need to pay off X, Y, and Z if you had like credit cards or student loan, something that can be paid off without doing damage to your savings account. So 43%, good guide, right? But not the be all and end all, right? There's a little bit of wiggle room in there. How do you figure it out? Let's say you're a W-2 employee, you earn $80,000 a year. You divide 80,000 by 12 months to get your gross monthly income. And the numbers are here. Remember, you're going to get this presentation tomorrow sometime during the day. So you'll have the formula so that you can see it. So 80,000 divided by 12 is $6,666.67. You times that by 0.43 to get 2,866.67. So that would be the number you should not exceed in payment, principal, interest, taxes, insurance, private mortgage insurance, and all other debt, right? The old scenario that we use, and I'm sorry, I looked at this webinar and I thought I updated it, but numbers are numbers, we can still use this. So let's say the purchase price was $460, the down payment was 3%, your loan amount is $446,200. I used a 30-year fixed interest rate of 6.375 with an APR of 7.3116. And that says of 9/15/2022. I'm going to tell you rates are pretty much around that. Not 100%, but pretty much around that. So we're not too far off the mark. So at a loan amount of $446,200, an interest rate of 6.375, your APR of 7.3116. Your principal and interest payment would be $2,700 alone, but we've already exceeded our $2,800, right? Or very close to it, right? Your real estate taxes at $625, your homeowners insurance we're estimating at $100, and private mortgage insurance is estimated at $260. So your total housing payment would be $3,768.99. Now, these numbers are a little scary, and I understand that, but I really just want you to be prepared, and knowledge is power. The more you know, the more you can plan. So clearly we're over, right? 3,700,688.99 was your total housing payment. You wouldn't qualify for a 30-year fixed rate. We've gone over, we can and have gone over the 43 to 48. Let's do the math. Even at 48%, we'd be at $3,200 a month. We're still over. We've gone up to 50. We don't like doing it, and that's entirely up to the private mortgage insurance companies, right? Again, has to be a strong deal. But even at 50% of your gross monthly income, it'd still be $3,333.34, and your housing payment alone is $3,700 and change. That's for a fixed rate. What about an adjustable? Now, adjustable rate mortgages are not all bad. I want to put that out there. Okay, they're not all bad. You can make an ARM work for you. You just have to be a savvy homeowner and home buyer. Okay, most mortgages are paid off between years 7 and 10 for a myriad of reasons. Okay, homeowners have accrued equity in their home and want to take out equity to do some home improvements. Maybe somebody's having a child that's going to college and they want to refinance their house to fund the education. They refinance, okay? So you don't have to take a fixed rate mortgage. Most times adjustable rates are a little bit lower than fixed. On September 15th, our ARM, our 7/6 ARM was at 5% with an APR of 5.07. It was significantly less than the 30-year, right? Our 5/6 ARM on the same date was at 4.75 with an APR of 4.820. The APR, just so that you know, is the annual percentage rate, and that has your closing costs, certain closing costs amortized in over 30 years, okay? But honestly, I just said that most loans pay off between years 7 and 10, so your true rate is the interest rate, okay? Let's look at the numbers, right? So a 7/6 ARM, principal and interest, $23.95.31. The same real estate taxes, homeowners insurance, and PMI were at $33.80. Okay, that's significantly better than where we were for the fixed rate, I think. And the 5/6 ARM is at 4.75% with that APR of 4.820, right? Your principal and interest payment is $2,327.59. Sorry about that. Same taxes, same insurance, same PMI for a payment of $3,312.87. So you would qualify, right? At a 50% ratio, you would qualify. But if you have other debt, that's going to negate that, right? That's going to take you out of the running. We would have to lower your purchase price. And I show you these slides and I show you these numbers because these are based on scenarios that have happened. But it also gives you the general idea, right? And it gives you a way to plan how you're going to proceed. Your unique scenario should be discussed with a loan officer so that they can help guide you. Nothing is hopeless and nothing is set in stone as far as these numbers. These are just examples. Again, we have the team. They can go over all of your income assets. They can, the area that you're going to be looking for your home, and they can help guide you. Personally, I always tell every member I speak to, it's never too early to speak to a loan officer. That's our only role here, is to help you get into a home. So it's never a waste of our time. Please don't ever feel that it is. It's not. I personally love to hear from members. I love to help members. I love to match you up with a particular loan officer who I think after speaking to you is going to help you achieve your goal. And again, I'm speaking ahead of the slides. I do apologize. But again, planning to buy 3, 6, 12 months, we don't have to run your credit for a conversation. A conversation costs nothing. When you're ready, there'll be paperwork we need to see. It's always the same paperwork. As Oscar said at the beginning, I've been doing this over 35 years. Actually, this year is the start of my 40th year in the industry, which A means I'm really old, and B means that I've kind of seen the gamut of real estate markets. But one thing I can tell you in the 40 years that I've been doing this is that the documentation that we need hasn't really changed, okay? And this slide has the most commonly requested documentation. So it's 1 month pay stubs if you're W-2'd, last 2 years W-2s, last 2 months complete bank statements. And I'm going to tell you, even if your bank statement, like Chase, always leaves the last page intentionally blank, we still need that page. Even though everybody knows that that last page is left blank intentionally, if it's 6 of 6, we still need that page. That's not an Affinity rule. That's a Fannie Mae, Federal National Mortgage Association rule. We have to have all pages. If you're self-employed, we're going to need your last 2 years business and personal returns with all pages and schedules. Now, there may be an additional document requested. That is not us asking you for the same thing over and over again, okay? Sometimes when we provide the underwriter with documentation, I'm just going to use tax returns as an example. They might have a question. That's perfectly okay. That's nothing to be concerned about. Just provide what they're asking for, okay? You're coming to our institution or any institution for a significant amount of money. We have the right and the responsibility to ask for documentation. It's not a big deal. The sooner you provide it, the sooner we can move on. I'm going to tell you, with the pre-approvals, it's so much better for our members, and members have noticed and have commented on it. We get them pre-approved, they provide all this documentation. Maybe when they find a house, because the market is very tight right now as far as inventory, maybe when they find the house, we have to update a bank statement. They're like, oh, that's all I have to do? We're like, yeah. Oh, this is so easy. It can be easy. Work with us, and we're going to make this as easy for you as we possibly can. Once you have a pre-approval, if you don't have a realtor already, we have the Home Advantage program. The realtors on the program have been vetted by the Home Advantage company and have agreed to give AFCU members back a percentage of their commission. This program can be used if you were buying and selling, or either of the two. And we can help you connect you with the realtor in the area. So it's another member benefit we're extending to you. Here's the link for the loan officers, and I'm going to open it up for questions.
Fantastic. Thank you so much, Caroline, for such great presentation. Yes, at this point, we would like to open up the floor for any questions that any one of you may have. As Caroline mentioned, she's been in the mortgage industry for a long time, so she will be able to answer any question. And if she's unable to find the answer, we will research the answer for you and get back to you via email. With that said, yeah, well, with that said, let me take a look if there's any questions pending. There are a couple. Okay, very good. So first question, how is it calculated with a cosigner?
Okay, it's a great question. So if you have a cosigner, let's say you had a cosigner and you made 80,000 and they made 80,000. Take 160,000 and divided it by 12 and then times it by 0.43. So I'm doing it right now on my calculator. Hang on one second. So 43% of 160,000 is $5,733.33. Okay, so just add them together and again divide by 12. Oscar?
I apologize. Okay,
That's
I
okay.
thought you were still answering the question, but yeah, just finished. Sorry about that. Okay, next question. Let's say you have a purchase price of $385 and you put down 20%. What would be the estimated monthly mortgage payment?
Okay, that's a hard one to answer because I need to know the interest rate and your credit score, right? So I'm going to go back in the presentation and I'm going to use I'm going to use the 7/6 arm just to give you an idea, okay? So if we did 385, you said was the purchase price. Again, I'm using my calculator, everyone. You're putting down 20%, which is like 70 something thousand. So your loan amount would be $308,000. All right, term interest rate. Based on the 7/6 arm in this presentation at an interest rate of 5 with an APR of 5.07, your principal and interest payment would be $1,653.41. You would not have private mortgage insurance, aka PMI, because you put down 20%, but you still have to add to that your real estate taxes and homeowners insurance.
Okay, excellent, fantastic. Next, can you explain more about why most mortgages are paid off between 7 and 10 years?
Sure. So let's look at it this way. You purchased a home, you took an adjustable rate mortgage, because the rate was lower and it allowed you to qualify for more home, which you can. And you were unsure if you were going to stay in that home or if it was going to be your starter home, right? You're into the loan for 5 years, the interest rates come down, and you say, you know what, we're really happy here. The school district is good. Our church is here. The shopping is good. We really don't want to leave. We think we want to, and we're in a better financial position. We've reached, peak performance in our jobs or whatever. We want to refinance. We want to pay our mortgage off faster. So we're going to refinance from an adjustable 30-year mortgage. We're going to go to a 15-year fixed. That's one reason. Another reason is people, even with 30-year fixed rate mortgages, people refinance when they accumulate some equity in the home. They want to redo their kitchen, or they want to do their bathroom, or they want to do a combination of a lot of renovations. They use the equity in the home, they pull that out, and they refinance their mortgage. So there's no right or wrong. You can refinance as often or as little as you want, but historically it's been between years 7 and 10.
Okay, next, does a pre-approval expires? And if yes, how long is it valid for?
So yes, the pre-approval it does expire. It's good for 120 days, which is how long your credit report is good for.
Okay. Do you have referrals for real estate lawyers?
So depending on where you are in New Jersey, because that's where we're based, we know a couple of real estate lawyers we can refer, sure. If you're out of New Jersey, New York, PA area, I'm going to say probably not. But your realtor will have recommendations for attorneys. They usually do.
All righty. If we inherit money, can that be counted towards the amount we can finance?
I'm not sure. I'm going to guess what I think you mean. And if I'm wrong, please correct me. So if you inherit money, it would be a lump sum distribution. That could be used towards your down payment and closing costs, but it wouldn't be, it's not income, right? We couldn't use it to qualify you.
Okay. Next, do you offer an FHA first-time loan?
We don't offer FHA. So FHA, the difference between FHA and conventional, which is the only loans that we do, are FHA requires you to put 3.5% down. I have first-time home buyer program that allows you to put 3% down. FHA is more forgiving in credit score. FHA allows you a credit score of 580, and our minimum credit score is 620. So I have something similar to FHA, but not when compared to credit score.
All right, next question is a really good one, I think. We have a bit of credit card debt under my name because my husband was working on getting a full-time PhD. We're thinking of withdrawing from one of our retirement accounts to address that. Is it better to apply those dollars to paying down debt or making a down payment on a house?
Okay, so it's not as cut and dry as you would think, and I'm going to give you very generic advice, but I would really love to have a conversation with you to go into a deep dive. But here's the short answer. Depending on the retirement account, you may face tax penalties for withdrawing those funds, right? So I tend to always caution our members before they withdraw from a 401k or IRA or whatever the fund might be to check with their financial advisor, because I don't want to tell you to do something that's going to cost you money and significant money in the long run. Depending on the credit card debt, you might not even need to do that, right? I mean, we have what's called a debt consolidation loan where we could pay off, your credit card debt and give you one payment per month. So before you would do anything, I would love to chat, right, and do a little bit deeper dive. And I'm sorry if that doesn't answer your question 100%.
All right, very good. Next, what type of assistance do you have for first-time home buyers in terms of assistance with closing costs or down payments?
So the credit union does not offer closing costs or down payment assistance. There are outside agencies that we have a lovely gentleman by the name of James Goodman, who's familiar with what grants and assistance is available. And if you want to email me, I can provide you with his contact information.
Okay, excellent. Next, what is the recommended credit score range?
Okay, so higher is always better, right? The minimum credit score is 620. That's going to get you the highest possible rate. 780 and above is going to get you the best possible rate. I can tell you our average based upon the loans we're doing now is at about a 740, which is still great credit. It's just that the government's agencies, Fannie Mae, Freddie Mac, they added new tiers for credit and added the 780 and above. But 740 and above is pretty common. 780 is best possible pricing.
Excellent, fantastic. All right, very good. So I just want to remind everybody that you guys will receive an email tomorrow with the link to be able to rewatch this presentation. There have been a couple of members that have asked me for the actual slides. So I will be able to share the slides with all of you, but unfortunately will not be in the email tomorrow. So it'll be in a separate email that I can send directly from my inbox. That way you guys will be able to see whether you guys want to have the links that I'll be sharing in the chat, or the actual PDF with the slides on it. Also in the chat there is one, and I'll share it right now. Copy, here we go. I'm sharing it right now. You guys should be able to see it. That last message that I sent, you will be able to see the slides for today's presentation there. And you will be able to download them as well. So I will still send you the slides via email, but you should be able to access the slides right away, right now.
Oscar, okay? I think we got a couple more questions.
Yes. So next question. If a person has enough money to buy the house, what is the pathway?
So I think in cash, you have enough cash to buy the house outright, or you have enough cash for down payment and closing costs. So I'm going to go that route. And then if I'm wrong, email me and we could discuss it more. If you have enough money, then the first step is reach out to a loan officer to get pre-approved, and then they can hook you up with the realtor in the area that you're looking to purchase. If you have money and you want to pay cash for the home and you need a referral to a realtor, that the loan officer can do that as well.
Okay, excellent. If I'm retired and looking to relocate to South Carolina, can Affinity help with mortgage, or do I need to get someone in South Carolina?
We can absolutely help you with the mortgage. We lend in all 50 states. We can also help you find a realtor down there if you don't have one through the Home Advantage program.
Okay, excellent. And then another question here, it says, can you share the first webinar's recording? Yes, by every one of you registering for the first part or this part, you automatically register for all 4 parts, and you will receive the follow-up emails with the recordings of each session. So if you signed up for the first part, and then you're gonna get the follow-up email with today's recording in the first part, and then next week you receive the follow-up email with part 1, part 2, and part 3. So there's no, don't be worried about the fact that you may be missing some information. Eventually you'll be able to receive the recordings for all of the parts. All right, next question. If we are the first-time home buyer relocating to South Carolina, is there any help with help available through you? So perhaps you may want to like elaborate a little more on what kind of help would you be mentioning? What would you're talking about? Because as Carolyn mentioned, James is really good with programs here in New Jersey, but perhaps there is someone down there who will be able to assist in that regard, right, Carolyn?
That's correct, Oscar. Usually the realtors will know if there's any down payment assistance or closing cost assistance available in South Carolina. That's a little bit further than James's reach as far as grant programs go.
Gotcha. Very good. Next, I missed to attend the first part of this series. Is there a way to access that presentation, which is what I was just mentioning? I will be able to share the recording link to the first part, but since you're here this evening, tomorrow's email, which will be the follow-up email thanking you for attending, we'll have both links, part 1 and part 2. So no worries there. You will eventually be able to watch the first part as well. Next question. Can you explain a little more about the ARM loan? How does it work?
Absolutely. Okay, so I'm going to use the 7-6 ARM just as a example. So you're fixed for 7 years, which is why a lot of people will go for that, because it's a generous amount of time, right? And in that time, you're going to know if you're going to stay or if you're going to go, right? You're fixed for 7 years at the interest rate that you close at, whatever that interest rate is. After 7 years, your rate is going to adjust every 6 months for the rest of the life of the loan. That's another reason why loans are paid off between years 7 and 10, right? If people take a 7-year ARM and it gets you in the home, like I don't want you to be afraid of it, let the loan work for you. It's a lower interest rate. It's designed to get you in your home, but then you're an educated and smart home buyer and you say, okay, I have 7 years or 6.5 years or 6 years and 10 months at this interest rate with this loan product. I'm going to pay attention when fixed rates come down, or if I decide I'm not going to stay in this home, I'm going to start looking prior to my adjustment day. So they're not all bad. They're not all dangerous. You just have to be aware of what you're doing.
Fantastic. Very good. All right. So that's the end of the questions for the time being. I'm sure that somebody will get another question in there before I close this webinar out. So until I do that, I just wanted to mention to you guys, I noticed that there's a lot of M members that they're asking for the first part of the webinar. So I will be sending you guys an email thanking you for attending, not the one for tomorrow. This evening, I'll be sending you an email. So please be on the lookout for this email. I will include in this email the links from the chat. I will include the slides for each one, part 1 and part 2, so you guys can have them handy. And I will also include the 2 links for everybody to see the presentations. Please don't be alarmed if you get another email tomorrow with kind of like the same information. I just want to make sure that everybody here has all the information and you guys are prepared for this journey. So I'll be more than happy to share that with all of you this evening. All right, very good. Next question. Do I need to make an appointment to see a mortgage counselor I would like to go into the Edison office.
So Arthur Reinertson, Arthur, is the loan officer assigned to the Edison branch. You do need an appointment only because he's not there every day. Arthur's phone number, if you're ready, I'm going to pull it right out of my phone. Give me a second. I'll give it to you. Arthur's phone number is 908-381-1190. You can give him a call and schedule an appointment. Tell him that you attended the webinars, which thank you for attending, and that I provided you with this telephone number. I also want you guys to see that I put my email address up there for you to write down. I'm serious when I say I love to hear from you. I love to answer your questions. That's the highlight of my day, sincerely. So please don't be shy. Reach out, ask away. This is my role here. My only role here is to make and help you get into your home.
And also, I just shared with everybody on the chat the link to reach our home page, our website, where you'll be able to see the information for all of our mortgage loan officers. So for this member that is looking to go into the Edison office, if you click that link, the third picture that you'll see there, that's Arthur. You will be able to contact him that way as well, if you want to set up the appointment with him directly. Okay. Very good. Next question. If the interest rates drop, will the fixed rate for the first 7 years drop or remain the same?
No, it remains the same. Once you close on a loan, you're locked into that interest rate for the 7 years. So if it goes up, you don't care because you're remaining at that, at your lock, the interest rate you closed at. If it goes down, it's a double-edged sword. You're at your rate is your rate when you sign the documents.
All right, very good. Let me see if there's any other questions. No questions at the moment, Carolyn. So at this point, I would like to bring this webinar to a close. I hope it was informative to all of you this evening. As I mentioned before, you guys will receive the links to rewatch the 2 presentations this evening. I'll send them out to all of you. And also, please don't forget that you guys are already registered for part 3, which will happen next Wednesday at 6 p.m. And then there is a part 4 that will talk about credit. So make sure to not miss these two extra seminars that are happening, because one builds off of the previous one. Each one builds off of the previous one, so you don't want to miss out. Okay. Carolyn, do you have any parting words?
Thank you for attending. I hope you found it useful. Please reach out if you need to, and have a great evening. I hope to see you next week.
Fantastic. Thank you so much, everybody, for attending. Please be on the lookout for my email. Thank you for attending, and have a wonderful evening. See you guys next week. Bye, everybody.